will U.S. consumers run out of money, and if so, when? A lot of really interesting U.S. statistics kind of turning over into new areas over the course of the last few months here as we fully get out of pandemic mode and all of the weird economic action that the U.S. Saw around that, and we'll dive into it a little bit just to give the background context. Now we're almost fully in, out of the pandemic and the dip, and then the bounce back that we saw there, went through the inflation period here in the US, and now coming out on the other side of all of essentially the last 2 or 3 years of general weirdness, economic downturn, economic bounce back to new all-time highs. Now so good that we're seeing inflation, interest rates rising, and now inflation lowering. Now the dust has settled, so to speak, and people are wondering, well, where are we? Where is the U.S. economy? We're hearing bad news from China and from Australia and from the Eurozone. Is the U.S. the next to be hit? Are these interest rates going to sink the U.S. Consumer? Rent and all these different prices for things are still rising. What does it all mean for the U.S. consumer? And we're going to dive into it right now and start with the rising prices that so many people have been speaking to. And now this chart, on the face of it, looks totally uninteresting. It's an upward sloping line, and it is the average annual rent here of primary residents in U.S. cities. And if you want to dive into what exactly goes into this calculation, you can absolutely go to the U.S. Bureau of Labor Statistics or the St. Louis Fed and take a look at that. But for all intents and purposes, we're looking at the average U.S. rental price for the last 20 years or so. And like I say, it's an upward sloping line, hasn't done any kind of zigzagging effect. It's not like, in 2012, rent was lower than it was in 2011, pretty much increasing throughout. But it is worth noting the last 2 years here, and I've highlighted there in red, the slope of that line is a little bit more upward and aggressive, which is to say that rental prices have increased in the last 2 years by more than average. The average in this time frame is about 2 to 4% annually, and that probably jives with what you anecdotally know if you have rented in the last 20 years. From 1 year to the next, usually prices increasing by 2 to 4%. In the last 2 years, rental prices have actually jumped by 15%, which is to say about 7.5% per year in the last 2 years, which is obviously more than twice the average over the course of the last 20 years here. And so rental prices are increasing a lot faster than average. And there are also prices for a number of goods and services. If you've taken a look at inflation over the course of the last 24 months, prices for a number of items have been increasing year over year in the last 2 years at a rate that has not been seen in the last 10, 20, even 30 years when you're looking at some parts of the economy. And this has people wondering, how does this affect savings? How does this affect the U.S. consumers' total amount of money and how much they have to be spending on rent, on food, on energy, and everything else? Well, you can see a pretty clear adverse effect. And now we're looking at the same data source here, but now the personal savings rate. And it has been the lowest in the last 2 years since 2007, 2008 range. We're pretty consistently around 5% of overall disposable income being allotted to personal savings. And in the last year and a half, 2 years, have been pretty consistently under that 5% metric. Still, at a semi-healthy 3, 4, close to 5%. But like I say, for the first time since 2007, 2008 range, consistently under what has been that average for the last 20 years. And you can't help but align that same time window with this jump in rental prices and jump in so many different goods and services, the prices for those vis-a-vis inflation that's been so high over the last 2 years, and correlate this same thing. But we do have to take in the full scope of things. One, the average U.S. Consumer was saving at some of the highest rates throughout the pandemic. You can see in the early part of 2020 and then into the middle part of 2021, some unprecedented levels of saving. And a lot of that, I remember anecdotally as well, and I'm sure a lot of you out there remember either seeing on social media or talking to friends and family about how, oh yeah, the government is cutting us this check for, $1,000, $2,000, whatever it was, depending on your economic status, for, pandemic spending. And a lot of people saved that money. And so it was like, oh man, hopefully you didn't lose your job during the pandemic or as a result of the pandemic. And now we're getting, the student loans that were suspended for that period. Oh, I don't have to deal with that monthly payment. I'm still getting my normal salary, my normal income, and they're throwing money on top of it. And so a lot of people were saving in double-digit territory for a number of months between 2020 and 2021. So maybe a little reversion to the mean here of people saving less, since a lot of stuff has been opened in the last year or two, but also those prices increasing, and it is correlated to inflation in some ways. The other thing that we have to take into account is that wages grew at an unprecedented level in this period as well. Wages grew actually by the most in 2021 and 2022 in the 21st century. You have to go back to earlier than 2000 to find one, wage growth above 5%, but two, actually from the Federal Reserve Bank of Atlanta, I didn't find any data points going back in their database that saw the wage growth that we witnessed here in the U.S. in 2022 in particular, got up to 6.7% year over year wage growth. And so you look at this period of the last 2 years, whereby we had a 6.7% wage growth and a 5.3% wage growth, essentially amounting to almost 15% growth in wages in that 2-year span. You tie that with this unprecedented wage growth that we saw coming off of people being able to save 10%, 15%, 20%, even more on average at certain points throughout the pandemic. And yeah, you're going to get some increased rental prices and increased prices for goods and services as, the economy is so synergetic that when one thing shifts, when consumers have a little bit more money, the prices of these different things rise with that. And oftentimes also, if prices are rising, then businesses maybe are doing better on a notional level, and they're able to pass on higher wages to the employees. And obviously, it's been a very competitive job market over the course of the last 2 to 3 years, as our unemployment rate has been essentially as close to zero as it can theoretically be. So, with all that being said, your message here is that, yes, things are more expensive now than they have ever been. When you're looking at that rental price chart, it has increased in the last 2 years more than it has in years past, but also these other parts of the economy are moving in the same direction. So hopefully not only is rent going up, but your wages on average have been going up as well. Now, where can this turn? Where can consumers run out of money, so to speak, and what can create a problem in this synergetic U.S. economy? Well, you rope in interest rates, and this is where things get a little bit hairy, is we are at highs for U.S. interest rates for the last 20 years plus here. The U.S. 10-year right now is sitting around 4.25%. That has been the high, and now potentially looking at moving beyond that, and the Federal Reserve looking at hiking interest rates north of 5.5%, maybe even north of 6%. And so this has people wondering if we can effectively hit this soft landing that's been talked about so much, whereby rental prices and inflation and these different metrics slow down back to their average, but also wage growth and these employment metrics also slow down to their average, and effectively giving you that soft landing without one thing necessarily falling through the floor and having this knock-on effect on several other parts of the economy. And where you're going to want to watch for this is going to be employment data here, because that's what's going to really dictate a lot of what you might see in inflation and interest rates and a lot of these other markets after the fact. You might always hear traders talking about non-farm payrolls and the unemployment data that comes out as being such big pieces of what moves the market and what they trade off of. And it's because it is a real primary source for not only, interest rates and these major markets, stocks and everything else, but also it has a knock-on effect of, if unemployment rises, if wage growth falls, you're likely then to see a month or 2 or 3 down the line, inflation fall and maybe rental prices fall as well. So you'll want to watch to see here if we see any kind of spike in the unemployment rate. You can see here in the last 2 years, it's been pretty much dead right down there at 2.5% to 3.5%, which is deemed healthy by economists. If that ticks up close to 5%, or you start to see a non-farm payrolls number that's negative, or you see wage growth that's negative, that's when the questions might come up that U.S. consumers now have not enough money to facilitate these inflated prices for rent and goods and services and everything else.